Good morning, my name is Sue Gull. I'm here with my colleague Paul Goddard to welcome you to the latest in our Advisor Lives. Just a little bit about Advisor Live before we start. It's somewhere between a webinar and a podcast and a training session. It's designed to be short and sweet and as interactive. Given the numbers, what we've done is we've muted the microphones and ask that you contribute to the discussion and address questions via the chat box on the right-hand side. What we want to achieve with Advisor Live is something that's timely, relevant, easy, and hopefully engaging as well. We've set 3 ground rules. We'll be doing these sessions at least weekly or more frequently where events dictate. They'll last no more than 30 minutes, and we'll make them as collaborative as possible and ensure we follow up on questions raised in real time and in summary after the session. We hope you'll find the Advisor Live useful, and we welcome any feedback to hello@scruttonbland.co.uk. Okay, on with today's subject, misleading figures, malicious or misguided. There's been a lot of press comment on this over the years, particularly with the failure of some quite high-profile names where the figures have not always been a very good indicator of the real state of the organisation, and that was before COVID-19. Now, Paul and I, between us, we clock up over 50 years of audit and advisory experience, which is scary. And our work has often given us quite a unique insight into our clients' affairs. Although we haven't, of course, come up against anything quite like a global pandemic before, what experience does tell us is that those with accurate information are going to be in a much better position than those working in the dark, and access to funds will be a deciding factor on who can come through the testing months to come. We've had considerable help from the government in terms of job retention scheme, deferment of taxes, other financial support, but in the next few years, cash and profit will be decisive factors if your organisation is going to thrive and survive. And the trouble with funds, whether they're cash or digital, is that once the stable door is open and the proverbial horse has bolted, there's very little chance of getting the money back. I read a recent quote that an extended boom often makes for shifty behaviour. Now, experience of 3 recessions, this made me stop and think, because I'd worked all that time on the assumption that shortage of cash and profits in a recession put people under pressure to do things they wouldn't ordinarily do. However, thinking back over experience of several decades, it is true to say that when times are good, there are opportunities for things to be hidden. As soon as the tide of profit and cash starts to recede, all too often unpleasant things get uncovered. It's a bit like watching a beautiful tidal river go out and wishing you'd not stopped around to see all the old rubbish emerge. I can quote a lot of statistics, but there is no doubt that when things get tight, misleading financial information gets exposed. And Paul made a very good point when we were talking about how we approach this webinar. He pointed out it's often difficult to tell, particularly when you're first faced with some form of poor information, whether it's fraud or just plain incompetence. And sometimes it's about people protecting someone as well. Quite often the warning signs are very difficult to pick up. The figures don't quite tie up. Differences on supporting figures get questioned because we're looking that much more closely. And then there are explanations about how things have always been done like that. It's always very difficult when it comes to the surface, and people have been trusted within organisations for a very long time. Frankly, it's more than a little awkward to tackle employees who may have been doing things a certain way for years and years, and it's only when cash gets tight that things start to get questioned. Now, we should make it clear this webinar is not about cyber fraud. This is a specialist area, and I'll leave that to colleagues who are much better technologically than me. What Paul and I are talking about are case studies of real-life situations, names protected, of course, which we have come across, which highlight issues that have led to their organisations running into real trouble. And most of them aren't rocket science. But in a rapidly changing situation like we're in at the moment, sometimes the basics get overlooked. As well as looking at some brief case studies and covering some of the common issues that we've come across, we're also going to look at some protective and detective ways of protecting your organisation. Some simple, straightforward ideas that you revisited, put into practice very quickly. And if they meet with resistance, then you can always blame the auditors. We have broad shoulders, we're quite used to it. And it can be a far easier route than trying to explain to somebody that you've trusted for years and years why suddenly you feel the need you've been doing. And that's one of the key difficulties. The number of times that we get told, it's always been done that way, it's never been a problem. I've heard that phrase over and over again, and particularly with one of my, well, I won't say it's my favourite, but it is one that often leads us down the road of looking more closely, and that's debit balances on the purchase ledger. Of course, this is a little bit of accountancy speak, but it's worth remembering that no matter what anybody tries to argue, a debit balance can only ever be either a cost or an asset. Double entry bookkeeping is essentially quite straightforward. If it's a debit, it's a cost or an asset, and if it's a credit, it's either income and profit or a liability. There's a whole range of clever things that get done in between. But if you're looking at a list of creditors and it's got an asset sat in the middle, then it's frequently worth looking into. It might be bona fide. A payment could have been made in advance before the invoice is received. Or it might even have been made twice in error, so it is an asset because the money's due back to you. But if it's been there any length of time, then it's likely to indicate a potential problem. One of the best ones I came across was when I was working in regional lending for a bank during the recession of the early 1990s and was asked to look into a very well-known local family business that had been operating literally for hundreds of years. The bank was quite confused as to why, after many years of profitable trading, we were at the end of the 80s, remember, there seemed to be a drain on cash, especially as there were a large number of customer deposits paid in advance. The debit balances on the purchase ledger were quite large, and the owner, a respected member of the local business community and about fifth generation of the company, explained them, without batting an eyelid, as prepayments in respect of rent. Of course, that could so easily have been true. Rent payable in advance is often left as a debit balance on the landlord's purchase ledger account, but a bit of digging showed it wasn't a prepayment of rent at all. He'd invested in some rather interesting property in the Far East, and the bank were not at all impressed when we traced the payments through to find the investment in the Far East was worth virtually nothing. The cash was gone, and by the time the insolvency crew came in, the bank and other creditors were out of pocket by a considerable amount. I'm sure a lot of people look very carefully at their list of debtors. Often the creditors list can take a bit of a back seat. My advice is to look carefully at both. Make sure they tie up to the debtor and creditor figures in your management accounts and raise questions. If there are credits on your debtors and debits on your creditors, or lots of reconciling items, if the aging looks a bit scruffy with amounts in the unallocated column so it's difficult to see exactly how old the debtor or creditor is, then dig down. And if there are cash or customer suspense accounts, check carefully. It might be the person in charge is not quite on top of their job and has got behind, or you genuinely are having to duck and dive a bit in these difficult times to make payments on account or get debtors in piecemeal. Or it could be that cash dries up. Earlier ducking and diving, whether it's incompetence or fraud, is becoming exposed. That's one of my favourites. Over to Paul for one of his.
Yeah, thank you, Sue. It's certainly up there in my top two. Good morning, everyone. I'm going to start talking by considering payroll fraud. Well, payroll frauds can be among the most damaging to a company because they tend to take place over a long period of time. The average duration between the start of a payroll fraud and its detection is 24 months, which is enough time to do some significant financial damage. It's established that almost a quarter of businesses are affected by payroll fraud each year, with the Chartered Institute of Professional Development reporting that payroll fraud costs in the UK private sector is up to £12 billion a year, which is very frightening. With the complexities around many payrolls as a result of the current pandemic, through the introduction of furlough, redundancies, changes in staff hours, temporary reductions in pay, some staff starters and leavers, and the wider impact on pension contributions, this has all increased the risk. And add to that the additional stresses placed on payroll staff, both as a direct and indirect result of COVID-19, and all whilst workforces are working from home. The challenges to ensure that accurate payrolls are being paid has increased. Most current payrolls are now too difficult to compare with prior months, leading to increased vulnerabilities to the payroll process. Well, payroll fraud is most often carried out by managers or senior employees within the payroll department that have access to the systems through which employees are paid, and they can use that access to issue false payments. It can also be carried out by employees who make false claims for payment, and they're probably the ones we see more often. Remember, it's often the long-term trusted employees who carry out these frauds, and companies with weak controls are most often the targets. I'm going to start by considering timesheet fraud, where employees who inflate their hours on timesheets are committing this type of fraud. A payroll officer or manager can also commit timesheet fraud by inflating the hours on another employee's timesheet, or altering the rate of pay, then transferring extra money into his or her own account before issuing the employee's pay. There are several effective ways to prevent and detect timesheet fraud to look at. Can you use electronic timesheets to eliminate the opportunity for an employee to change information after a claim is submitted? Have supervisors approve timesheets before they're submitted to payroll. Require that timesheets are completed and submitted on schedule to avoid delays. What you don't want is the supervisor having to recall 4 months ago for when a claim is being submitted. Schedule periodic independent spot checks of the payroll by someone outside of the department. They can compare timesheets to work schedules, but also it's important to ensure that staff are aware that these checks take place. Require a supervisor's documented approval for any changes to employee pay rates or employee types. Ensure that supervisors are close enough to the claimant's activities to legitimately approve the claim, and remind those staff of the importance of showing diligence when approving them, recognising that there's a significant risk to attach to signing claims based on trusting the individuals alone. Thinking about falsifying wages now, this can be carried out in collusion with another employee who then shares the extra pay with a payroll employee, but it's also sometimes committed alone. When done alone, the payroll department employee transfers the extra pay to another account before issuing the employee's salary for the correct amount. The employee doesn't know that the fraud is even happening and they're unknowingly participating. To prevent this, you should be able to use the exception reports that form part of your payroll sign-off to highlight changes in the current pay to prior months, noting, as I said earlier, that whilst in lockdown, some of the differences in recent months will be much more than normal. They need to be reviewed by someone independent of the payroll process. And make sure that there are clear forms, electronic or manual in nature, to support the reason for any change in salary being made, and for these to be authorised by an appropriate member of staff. Be very clear about who should be managing the approval process. While we're working remotely, it might be that systems and processes have needed to change. Are they still robust enough? You do need to reconcile the payroll against the agreed payroll budget, and contract records that are held by HR go back to source. Can you separate the roles of processing payroll and authorising the payroll? An important one is to ensure that your payroll officer or officers take their annual leave and that someone else becomes responsible for payroll during that period. Commission fraud and bonus fraud occurs when the employee whose pay is partially or fully based on commission or bonus inflates sales or posts non-existent sales which are later revised. Fraudsters might also post sales before they're finalised to collect commissions or bonuses earlier, or even collude with another person to create a sale that is later reversed. Payroll managers also commit commission fraud when they change the rate of commission for an employee, often in collusion with that person. To prevent and detect this type of fraud, you really need to ensure that there's a clear and enforced commissions policy in place. Can you conduct random spot check reviews of the payroll records and compare with the approved commission earned, and also evidence that the support of bonuses is there? Ensure that staff are aware that these spot checks are taking place. It's that awareness that I think is a very important one to prevent the will to perpetrate this type of fraud. Can you compare budgeted commission and bonus payments against actual pay costs? Look at the percentage of revenue paid out as commission and bonuses and see if it's above projection. Examine sale write-offs to see if a particular employee has more than others. I suspect where fraud is most prevalent is where employees are committing expense fraud. It's conceivable that staff that have been regularly committing expense fraud have become reliant on that additional income, and they find that they need to continue to make fraudulent claims even in the lockdown period. And in most cases, I suspect that fraudulent claims being carried out now will clearly stand out as a result of the significantly reduced activity in most cases. But to prevent and detect expense reimbursement fraud, again, you need to have that clear and enforceable expense policy. Can you adopt an electronic system to manage expenses to prevent claims for being manually adjusted? Make certain you require receipts to back up every claim submitted. Ensure that authorising staff understand their responsibilities when approving a claim for payment, and it is okay and right to ask questions of the claimant if points are unclear. Don't be rushed into signing these claims. Examine receipts to ensure they're authentic. Check dates and locations to ensure receipts match travel. Note claims with missing receipts and run comparisons to see if a particular employee has significantly more missing receipts than others. Complete the spot checks to recalculate distance travelled to authenticate claims being made. I think perhaps if expense claims is maybe the most common, one of the most financially damaging would be the ghost employee schemes. They're perpetrated by payroll employees who either create synthetic identities, complete with fake names, personal data, or continue to issue payments to employees who have left the company, diverting the pay to themselves. The closer attention that's been given to pay costs as a result of the pandemic may have resulted in the identification of a ghost employee. Perhaps a member of staff that had left the payroll was continuing to be paid. And this may have been a completely honest mistake and a breakdown of controls, but it might be signalling something more sinister. To look at these ghost employees and to try and manage them and detect them, you require documentation and authorization from authorized management before an employee can be added to the payroll. Use these exception reports to highlight any additional members of staff added to the payroll and include the verification of these as part of the independent payroll sign-off. You need to ensure that you have got this segregation of duties between the staff members maintaining the payroll and those personnel records. I've referred to that earlier. There's a really key theme, it's a key control. But an important one is where the size of the business is sufficient and appropriate to do so. Introduce a regular census check where the existence of staff on the payroll is physically verified by individuals independent of the payroll team. I think moving on to supplier fraud now, Sue, if I can.
Hi, Paul. Yes, indeed, Paul. I did just have one question, though.
Okay.
Back in the day being the early 80s for me, I worked for a large chain, which will remain nameless, but it was expected that managers would top up their pay by, well, how do I put it, creaming a little off the top. It was part of the fabric of the business, literally. Now, at Scrutton Bland, we start from induction by making it clear that falsifying timesheets is fraud, and there is zero tolerance for falsifying anything from an expense claim to an audit test. But it's a completely different culture. But is that a sign of the times, or do you still see organisations where my early experiences happen?
It's an interesting one. I mean, we don't often find cases of falsified records during our audit work, as we're looking for the correct staff sign-off and authorisation. But the fact that the payroll fraud is estimated to cost the UK so much, I think it suggests that the role of the individuals that are authorising claims and approving changes to the payroll is key. And it's key to set the tone and to stamp out fraud. And the numbers of these frauds suggest that these checks and balances aren't happening consistently well enough. Interesting. Thanks, Sue. Now moving on to supply fraud, please. Okay, so supply fraud occurs when someone wrongly convinces you to change a supplier's payment details by purporting to be a supplier you make payments to, and then request a payment be made to these new banking details. In some cases, businesses are currently operating with reduced staffing, but individuals multitasking and carrying out roles where their experience is not as strong. And alongside this, many well-established processes are likely to have changed since we began home working. The ability for staff to consistently make the correct decisions in these circumstances in the face of such attempted frauds could be impaired. Fraudsters are working hard. They're researching suppliers' websites to understand their activities and identify key staff. Unsuspecting employees can also be tricked into providing details, and this may include calls to gain information about procedures or payment processes. Fraudsters may telephone with a change of bank account detail request, often trying to target junior or inexperienced employees who may be more likely to accept the changes. You may receive a written request on forged letterhead quoting publicly available information such as company registration, director details. An email request could look completely legitimate, as fraudsters may have the ability to create electronic aliases and clone domain names. There are now cases where emailed invoices are being intercepted bank account details changed and then being forwarded to the correct recipient for payment. And I know that this is an area that has been well covered, and you will recognise most of the mitigating actions, but I think they're worth reflecting on. Have you trained and educated your staff in the potential dangers of providing sensitive company information, especially contract and account information? Have you introduced a rigorous change of supply details procedure? And when you're calling a supplier back to check the veracity of a request, are you using the details within your system rather than those on the associated letter or email? I think an important one is a periodic review of supplier accounts, identifying and removing old or dormant accounts in your system, reducing the likelihood of old supplier information being used to secure fraudulent payments. Think about how your payment details are shared with your suppliers. Do you have a secure means to do this? And alternatively, you could choose to issue invoices over a certain value without your payment details on at all, and you share that information with your supplier over the telephone instead. You need to make certain that payments that are only being made to suppliers based on the payment details you hold in your system. I think an area that I've seen firsthand where this has been a problem is if you're making faster payments, paying through CHAPS, where you're keying bank account details directly into the system. And if you and your team are doing that, you need to make certain that the supplier details you're using come from your finance system rather than what's recorded on the invoice. Thank you. Back to Sue.
Right, so on to three more of my my favourites in some ways. The credit card still seems a really obvious one, but it's surprising how often it still happens. The company credit card gets used for things other than business expenses. One of the saddest cases I ever had was a company where the bookkeeper and office manager had been trusted for years by the managing director, who was frequently away overseas and lived abroad. She was always there late, apparently working very hard. He told her to take a meal on the company each month as a reward for her efforts, and don't go into the P11D aspects of that one. For a while, this was simply posted to staff entertaining, but when we came to do the end-of-year accounts, we kept being fobbed off. Nothing was ready. She'd been ill. The dog had died, I remember that one. It was all very odd, and when we finally got a trial balance, there were strange balances on the petty cash account. Again, it was a debit balance on the petty cash account, which seemed to indicate a substantial amount of cash, which didn't equate to what was on the premises. We looked a bit deeper. It turned out that the monthly meal on the company had turned into curtains for her house, a family trip to Florida, and finally a swimming pool in her son's back garden. It was a very profitable company, and he was horrified. He couldn't believe it, and as we walked to the meeting, he turned around and said, "I can't do it," and the rest of the staff were furious. Mostly, in fact, about the fact that they'd given her a nice party for her 60th birthday, only to find out that she'd lied about her age. And that's one of the other things about fraud. Quite often it's the people who are working there who might spot something is wrong. In another case of credit card costs and debit balances on the purchase ledger, a young accountant joined a new company and worked out that the senior finance director had some very expensive habits involving racing cars, which didn't stack up with his salary or his family commitments. It was the young accountant who blew the whistle. But that sort of information is going to be so much harder to get now many of us are working remotely, and whether everything will go back to us working together in that way is in debate. Then there's credit notes, and sometimes it's not people blowing the whistle, it's people trying to help out a friend, and I've seen that with credit notes. This is an area where helping out a mate who's got in over their head in troubled times is often not even perceived as proper fraud. It's quite true to say that some accounting systems do require a lot of credit notes, but it can also be a quick way of covering tracks for stock or funds which have gone astray. A friend who's bought something they now can't afford, a bill for the solicitors, or stock that's been taken and sold on. And sometimes it can be a business reason, a salesperson or a fee earner who wanted to make their figures look good and so raised the invoice and now has to explain why it hasn't been paid. Quite often a review of the larger credit notes is carried out by senior members of management, but it's the small and regular ones that can be just as damaging to the fabric of the business. Getting someone independent of the process to run the full list and reviewing and questioning it can sometimes highlight some unexpected management issues. And if the list is very large, data analytic tools can arrange the information in a number of different ways. And the final one for me is journals, another mysterious area of accountancy. Journals should technically be reducing really because of the new and more reliable computer systems and often cloud-based systems where information is directly input and automatically analysed. But you always need a good understanding of the client's business because this is an area where over the years it has more often exposed people who are not quite up to the job than it is about fraud. If a lot of journals are being posted, it's worth asking why. Is it because the person has been making quite a few mistakes? And round some journals, things that are commonly posted by journal, like depreciation, prepayments, accruals, payroll, commissions, you wouldn't expect them to be round sum amounts. So round sum amounts always draw attention. Or if they're adjusting stock, if it's the year-end stock take being adjusted to a physical stock count, maybe, but things throughout the month, digging deep can highlight not only issues about potentially fraud, but also where people are simply not a really important one at the moment. Preventative and detective controls. So, preventative and detective controls. Time and again, we've seen that the culture of the organisation is key. In an organisation where top management insist that all the figures are backed by detail and agreed up, things are reviewed carefully, and that the detail supports all the main figures, it's much easier to get accurate information which flows through to the top. And even large and complex organisations can be accounted for in a straightforward manner. However, in a period of change, it's certainly not easy, but revisiting some of the basic controls can make a big difference. So just to summarise some of our top preventative controls. Ensuring systems and procedures for authorising costs and payments are clear and adhered to. If top management override those controls, then the rot starts at the top. Areas that are key to your business, payroll costs, credit notes, credit card bills, review them carefully and ask questions. Check your balance sheet. Are the assets really assets? Obtain lists of debtors and creditors and make sure the top level figures are supported by detailed breakdowns. And ask about journals and look for round sum and odd patterns. And finally, there's detective controls. One of the things we use more and more are the various computerized tools to analyze data into more user-friendly and easy to review formats. Some of our favorites include checking for dual payments, checking for small round goings, and checking wages costs to see if there are figures which have not come directly from the payroll. And if you've been given answers and want a second opinion or just want to talk, then please do pick up the phone or chat online. It's also really important that people have a route through which they can bring their concerns. And as we move to more remote working, especially in finance, when someone can't pop into the room next door and say, you know what, this doesn't look right, we'll all have to look at that. And I'm going to pass over to Paul, but Paul's slide is on whistleblowing and bribery, which is just a small point to finish the webinar on.
Yeah, thank you, Sue. Yeah, so some final thought. The worldwide outbreaks created unprecedented demand for products, services, so medical devices, healthcare industries, but many more. And coupled with the severe financial pressures on companies, it's likely to have created incentives for corrupt practice. When you think about the messaging that's been given to staff, have you been able to make it clear that no one will suffer for doing the right thing and that no one will be rewarded for doing the wrong? And the organisation is dedicated to long-term survival. It's not just about getting through the next few weeks any means necessary. You need to think about making certain concerns don't get stifled, that you have whistleblowing channels and they continue to operate and work effectively. Look out for the usual signs of fraud or corruption, staff that are keeping relationships with third parties to themselves, who are reluctant to be transparent, who don't just complain about the process, but actively root around it. Okay, well, I hope that some of these thoughts have been useful for you. It's great that you've been able to join us today. Thanks. These webinars are weekly, and we'll be sharing details of the next event shortly. We're posting articles and updates regularly on the website, and you can subscribe to our emails via the Scott & Bland website. If you do have any questions, we do our level best to answer these. So please do use our hello@scottandbland.co.uk email address, or use the comment section here within the webinar. Thanks. Have a good day.